Is Allegro's margin expansion a breakthrough or a mirage? Allegro MicroSystems is currently executing a massive strategic pivot. They are moving from simple analog parts to AI infrastructure. Fiscal 26 delivered a 22.8% revenue surge. Total net sales reached $890 million. This growth was driven by xEV powertrains and ADAS systems. Power IC revenue alone skyrocketed over 40% this year. Gross margins expanded by 200 basis points to 46.3%. This suggests strong pricing power in a competitive semiconductor market. But we must analyze the quality of these margins. Over 50% of revenue still comes from legacy sensors. These legacy parts are facing relentless average selling price erosion. Now, let us examine the balance sheet and liquidity. The company completed a massive share repurchase of 38 million shares. However, this was not funded by organic cash flow alone. They used a combination of new debt and equity offerings. Total net leverage has hit the 4.0 covenant ceiling. This means any dip in demand could trigger a breach. Operating cash flow rose to $163 million, but this was largely due to a drop in working capital. It was not driven by a surge in core earnings. We also see a $34 million non-cash loss. This came from a forward repurchase contract for shares. Now, let us discuss the extreme customer concentration risk. Over 70% of sales are tied to automotive customers. The automotive sector is notoriously cyclical and volatile. Two distributors alone account for nearly 20% of sales. This creates a dangerous single point of failure in the revenue stream. Supply chain fragility is another major concern in the 10K. They rely on a single internal test fab in the Philippines. This facility is vulnerable to natural disasters and geopolitical shifts. They also depend on a few key wafer fab partners like TSMC. The fabless model reduces capex but increases external dependency. Despite these risks, the technological moat is impressive. Their proprietary BCD wafer process is a significant advantage. StreamSense TMR technology allows for higher content per vehicle. This positions them well for the shift to 800-volt platforms. The transition to a data center power is also underway. This diversification is critical to reducing their automotive reliance. But the timing of this pivot must outpace the debt burden. If the analog cycle turns down, the leverage becomes a liability. They could face mandatory amortization or costly refinancing. In summary, Allegro is a high-risk, high-reward play. The technology is world-class, but the balance sheet is fragile. Investors should weigh the AI upside against the covenant risk. The 10K reveals a company at a critical crossroads. Success depends on executing the AI pivot before the debt peaks. That is the forensic reality of Allegro MicroSystems.